Welcome, everyone, to another episode of Financial 15. Kevin and I are ready to go, and we're talking about the emotional cycle of investing. In turbulent times, volatility hits, emotions are on high. What does that cycle look like? What can we do about it? Lots of great information. You definitely want to stick around.
Yeah, today we're going to talk about strictly that sort of investing side of things. Is it all just based on numbers and how things run there? Or do fear and greed really incorporate into how you run your portfolios? These are questions that need to be answered and things to take a look at. And that's what we're going to do today, is the emotional investing in regard to your scenario. So again, if you want this video or any of the others, please go to our YouTube channel and subscribe. Lots of great content there. You'll find a lot of things that are really important to you that help out. Or if you want, like us on Facebook. Most importantly, visit our website at beckerorr.com. You will find everything there between blogs, videos, as well as any of our event invitations and things going from there. But today we are dealing with the emotional cycle of investing. This is a real thing, and it is something we should consider, isn't it, Clint?
Absolutely. I'll pull it up. I'll jump right into it here. So this is the cycle. Now, you might look at different spots on the internet, talk to different people, and they'll have different specific emotions. Maybe they won't call it optimism or excitement. They'll have a different word for it. But this is the general premise. You see the emotions increase, the positive emotions, till you get right to that speculative euphoria stage. And then as the market turns, that gray line being the market ups and downs, you can see the negative emotions taken over till they get right to an absolute desperation point. And then the cycle continues as we rebound. So you can see the ups and downs of that, Kevin. And then we'll go through a few stages to see what people might be thinking, what the market will be doing. And we'll start, well, I think at the beginning. Stage one seems like a good place to start if we're going to be talking about this.
And that's always the best way to do it.
Yeah, I always start at the beginning. Start at the beginning.
We don't want to treat this like a cancer scenario, but it is a stage one scenario. And as you can see by this description here that we've got, this is using my mathematical minor skills from beforehand. We're dealing with a sine wave of emotions, and that's the way things are really based on it. So as we can say, stage one is basically, let's assume I'm new and, I'm looking at things down the road 30 years from now. I'm looking at stage one. I've got some optimism. Okay, maybe the markets aren't great now, but I honestly believe that going further, I'm not worried about the losing money in the short term or anything else. My investments in the long side will work out based on the history I've seen, how things have gone. I'm going to make money. So what I'm doing today is I'm investing. I have a little bit of optimism that, going forward, I'm going to be fine. Everything along that line looks good. And that's where I'm going to see. A lot of the times you get that, as I said. So, sort of that, if we look back in stages, 2003, sort of the area, 2010, 2011, if we're looking at where things are, even 2000, the end of 2020, 21, there's that optimism that things are going to go well and, I should be buying in.
Exactly. And note here, optimism is not euphoria. It's not people I'm being unrealistic. They're saying, you know what, I understand there's some risk involved here. Could be a potential loss, but I do think longer term it's going to work out. So it's more of an in-between state, right? More of a steady mind state as opposed to, people are too optimistic. Not the case, right? So we're calling that optimism. Other folks might use a different word, but the idea being it's a default state where you consider the risk and you consider the long term and you decide to invest. And then from there, stage two, that's where we get a little bit of a ramp up here. Look at that, the excitement, the thrill, the euphoria. That's where you start to see all those emotions really start to take over and that positive kind of acceleration of the emotions. And of course, it follows the markets. It doesn't happen in a vacuum. It happens because people are making money. The markets are going up. That's really what happens. And the better the markets do, well, the more the excitement grows. Often you see more press coverage, you see more headlines, friends and colleagues start talking about it, telling you how much money they make. You might start to feel like, hey, I'm missing out here. Everyone's getting rich.
That's right.
Me. Somehow I'm the only one not getting immediately wealthy from the market. And as the market growth gets sustained gains, our perception of risk can get reduced, right? We might think, there's no way I can lose on this. My friend made money. That former colleague of mine made money. We're all making money here. So that perception of reduced risk can lead to more speculation, more of that gambling mentality. Often what we see is it leads to more debt, people taking debt to make some bigger investments. And of course, we know it doesn't last forever. Eventually, the market peaks. And there's so many examples of this, Kevin. You can talk about the dot-com run up there when the internet was going to change the world. And it did. But it doesn't mean that all those dot-com companies were good investments. You can talk about the 08 scenario and many others, right?
Yeah, I would call this stage greed. This is where everybody wants to make money. I mean, you've got that sort of a casino atmosphere going on where there's nothing that can go wrong. Everything is making money. You can buy into anything. And you're right. The greed scenario, you mentioned it, that 2000.com, when the housing market really took off in the US all the way to 2008. And again, I mean, even if we take a look at where we were a year ago, the way coming out of the pandemic seemed to work on that scenario. So yeah, stage 2 gives us that. And I mean, if you're sitting there and you're getting your advice all of a sudden because the bartender down the street is giving you a few tips, we're definitely close to that. This is the end of the line scenario. So that's where we get that excitement, thrill, euphoria, and we peak. And that sort of leads us into the stage 3 scenario that we see coming forward.
Yeah, recently, I'd say it's stage 2 happened when you talk about all the cryptocurrencies, the NFTs, everyone getting overnight millionaires. Suddenly the New York Times and other media are doing like stories on these crypto millionaires. Like that was very much this stage, right? That was the euphoria taking over. And you get to stage 3, we'll move further on in our chart here. Unfortunately, so the negative emotions taking over. You can see the market's peaked, the market starts to fall. And you have a whole barrage of negative emotions that can take over: anxiety, denial, fear, desperation, panic. It all kind of hits you as the market falls. And that's really the key here, right? The market moves and the emotions follow through. So anxiety sets in as the market becomes more volatile. Initially, denial is probably the reaction, right? Oh, it's temporary. We're going to go back to the easy money days where everyone gets rich overnight. Temporary, not going to happen. Easy profits will return. But then as markets fall further, that desperation really starts to sit in. And then the panic can take over. And the panic is really when people extrapolate the current situation. We talked about this in our other video. We talked about the seduction of pessimism. Same idea here, right? Markets are falling. We think it's never going to end. We think that bad scenario will just keep going forever. It's going to go to zero. That's when the panic hits. And of course, that can mean panic selling where people rush for the exits.
Yeah, this is definitely more of the fear stage. There's no doubt about it. I mean, we've seen this a few times, but again, they've been more fleeting in the last little while. I mean, after the dot-com bubble, we had one there. After the Great Recession in 08, 09, we had one there. Other than that, we really haven't had a lot of these where they've led to that sort of end-all stage. But again, once you start to get into that panic mode, that's where it is. Markets have come off. You're right. They sort of say, well, okay, it's down 5 or 10%, nothing to worry about. Inflation's coming around, but it'll all solve itself out. Then you go another month and you're down another 5%. And all of a sudden, that's when the fear sets in that this is real. And maybe I should start getting out of this because I don't know how long this is going to last. And, you know, all those negative emotions start to get in and that panic sells. And all of a sudden, you're right. You're rushing to the exits for everything to come at the end of stage 3.
Yeah, and you're absolutely right. You kind of hit on 2 points there. One is it's not always the depth of the drop. Sometimes the market can drop 20, 30%, but it happens really quickly, like we saw in the pandemic in March of 2020. Maybe people don't go through all those emotions because it rebounds so fast. Maybe it doesn't drop as far, but it takes a long time. So people get a steady drip of negativity and the market's going down, down, down. It takes like 10 months or a year or 2 years, like in that 07, 08 time period. So the length of it can also be a big issue, right? And different ways we can end up going through that emotional cycle. But we'll get to the final stage here. Maybe that wasn't the best choice of terms since you're talking the cancer analogy, but stage 4 is actually a positive stage when it comes to the emotions of investing. You can see you get to the worst point, but then you get the other side, right, Kevin? You start to get a little hope, you get a little relief at the end of it.
Yeah, I mean, you get to that final point where, you know, there is nothing else I can do. This is where it is. I'm going to have to live through where it is. So you get to that sort of desperation phase saying, look, there's nothing else in the world. If it's going to go wrong, it's going to go wrong. I got to live with it. But after that point, sooner or later, you're going to start to see that the markets, if they start moving up, that's really when all of a sudden you get closer to that hope. So as we mentioned here, I mean, fear of further losses, you're at the point where, you know, everybody's thrown in the towel. There's nothing else I can do. I might as well hold on now. I've lost this much money. And who knows, eventually maybe it'll come around. If not, then I'm going to have to work my job a little longer. But all of a sudden, after you start seeing the markets move a little bit, that capitulation of hope comes. And usually it doesn't happen instantaneously. Very few people will ever buy right at the bottom. You're going to see some sort of the market's moved. It's up 5 or 10% from where that bottom was. Wow, you know what? There is some hope out there. There is considerable scenarios going forward. That hope's going to eventually lead back to stage 1 where the optimism comes in. And it's like, you know what? Maybe going forward, I still have this number of years. I'm going to get that considerable bounce. I'm going to get that relief coming in. I can buy into the market again. And that's what I need to deal with.
Yeah, and as the market falls and eventually bottoms, there's no optimism left in the market usually at that point, right? People have capitulated, they're thrown out. Sometimes you see complete revulsion where people are like, I'm done with the markets, throwing out my hands. I'm not an investor anymore. We saw that after that 07, 08 period for sure. not so much recently, but that certainly can happen. And then the journey to go from capitulation, from depression back to hope, that is a difficult journey. And like you mentioned, often it takes some considerable market movement, right? People won't normally buy the first bounce. It takes some time for people to, okay, the market's actually improving here. We've seen some positive momentum, and it takes a little bit, not just of gains in the market, but time for all of that to happen. And then you get back to the hope, and then the relief finally sets in. All right, we're back on a good path there. So that's kind of the journey, the emotional journey you can go through. How do you handle that journey, Kevin? Well, this is like a broken record. We say it every time, but you need to have a plan.
Yeah, and I mean, that's the biggest factor, because no matter how much anybody wants to admit to it, the emotional cycle of investing plays a part. We can tell you all about the numbers and look, it's long term. This happens. Ignore it. Don't look at anything and you'll be fine. But people have that view. They're going to look at it. When things are going really well, they're not worried. All of a sudden, when things drop off, you get that real panic. Should I get out now? Or should we sell things? Should I do this? You've got to have that plan. If you have the plan in place and you don't need the money for 10 years, today's going to seem like a fairly little blip in everything going forward. If you need the money tomorrow, we would have had that sort of incorporated. But having that plan is the most important part. If you follow the plan and take the emotion out of the investing, you're going to be much more successful going forward, as opposed to just living off of I've lost this or I've gained this sort of scenario going forward.
Yeah, and it's a broader financial plan, of course, to look at all your big financial pieces, whether it's your estate, your retirement, the tax situation, taking all that together. Then also part of that broader financial plan is an investment plan, which has to do with your suitability, your risk tolerance, all those good items. So the idea is you have the plan, then you stick to it, which is much more difficult than it sounds, because it's not as if we don't feel those emotions. Of course, everyone goes through those emotions. The idea that sticking to the plan and preventing us from acting on those emotions, right? So we feel them, we address them, but we don't actually implement them in the portfolio, because then if those take over, your plan's going to go out the window. So having the plan and then the ability to stick to it is key. And if you have more questions on this or any other topic, where should people go, Kevin?
They should go to chatwithclintonandkevin.com, because there's plenty of answers we can add on this. I mean, again, especially at times like this is the emotional time of investing for a lot of people when the market seems to be going down. We're more than happy to address what the plan situation is for you, or answer any questions you have on how long does this last, what do cycles look like, anything along those lines, and try to give you that sort of investing scenario. But yeah, if you have questions, please get in touch with us. Otherwise, I think we've covered sort of that broad sine wave of the emotional cycle of investing, and we're done with this one, moving on to the next chapter of our Financial 15 network.
There we go. Good way to end it. Take care, everyone. Stay safe.